Welcome to the channel. My name is Michael Baker, and for almost 2 decades, I've been helping people prepare and plan for retirement. And in this week's video, we're talking about Dave Ramsey's views on retirement and withdrawal rates. Let's check it out. Dave Ramsey is one of the most well-known voices on personal finance. But what made Dave say this?
$1 million should create for you an $80,000 income, boys and girls. So you should perpetually, like it forever. You should be able to pull 80,000 forever and never destroy it. Now and so when you tell people that $1 million creates a $40,000 income, you go, oh, I've got to have $2 million and I can't make that. Then this system doesn't work. So what you're doing with this bogus math is you're stealing people's hope. That's why I'm pissed about it. Because it's hope stealing with super nerds that have never really done anything to start with. They don't have any investments. They just have theories. I've actually freaking got investments.
All right, before we continue, I need a moment. I'll be right back. Okay, I'm ready to continue. Now, I remember when I saw this clip for the first time because it lit up social media and especially the retirement planning community. A lot of people were just astounded at what Dave was saying, especially when he was calling something bogus math. And if you want to know what that bogus math is, hang with me in this video because I will show you the clip out of Dave's own mouth, what he actually said. But before that, I want to show you a little bit more about the type of retirement advice that they tend to give out at the Ramsey radio show, because I think it's important for context just to see how they're thinking about this problem and where I think they're going wrong. Okay, let's take a look at this clip. The caller on the show, or the question was that they had a nest egg, I believe, of $1.4 million. And how do they know if that was enough to retire? And then this was the initial response that was given.
You don't want to burn through your nest egg, right? You want to have it invested in such a way that you're able to live off of the interest and not really touch the nest egg is what I would say. So that would be my first thought is I would use a calculator and kind of run this back and go, okay, what's the income that I think I'm going to need? And get that number. And then, okay, what does the draw off of my interest need to be? What does my nest egg need to be so that my draw can equal that? So I'm kind of reverse engineering it in that way. And then there's also the part of...
Okay. So what she is referring to is a type of investing. It may have different names. Most of the time, I refer to it as income-based investing, where you're looking at the yield of your investments. And basically, the idea is you don't want to touch your principal. You only want to use or touch or live on the yield or the income that the investments themselves generate. That is in and of itself can be done. However, you have to understand how yield works and how the pricing mechanisms work and the different types of investments. Okay. This is one of those things where it's like, we're not going off the cliff just yet, but we're going to get there. Here we go.
This, you're 54. I'm thinking, okay, you've got 1.4 million now. There's a good chance that in 7 years it could double. And that ain't bad.
Yeah. If you've got it invested at 10% or better, it doubles every 7 years.
Yeah. 10% or better. Yep.
So it's 61.
We say 10% or better like that. That's a given. Like we're definitely going to just, we put it in an investment and it's going to just get 10% per year every year. Like it's just that easy.
And if you're invested in good mutual funds, you're going to have 2.8. Mm-hmm. And at 68, you're going to have $5.5 million.
Now there is inflation to play into that.
No, I'm not talking about inflation.
Just actual dollars.
I'm just saying that if you're making 10%, it doubles every 7 years. A lump sum does. Mm-hmm. That's if you're adding nothing to it. Okay, so at 68, that's what you would have if you don't touch this. Now, if you got to retirement and
so what Dave is talking about is the rule of 72. Whatever interest rate you're getting and divided into 72. So 72 divided by 10 is 7.2. So if you're getting 10%, 7.2 years is the time it takes for that amount to double?
You had was 1.4 million. Then how would you calculate if that's enough? Just like Jade said, there's a couple of factors. There's inflation that you want to stay away from, and you need to look at your rate of return. So if you're invested in good growth stock mutual funds that are averaging what the stock market has averaged, the stock market has averaged 11.8% since it began, the Standard & Poor. Okay? So let's just pretend you're making 11%. We'll round down for the people that go bananas when I start talking about this stuff. All right, so we're going to round down. You're making 11%. All right, if you left 3 in there, so that it would grow a little bit to cover some inflation, and pulled off 8, that means you'd be living on $90,000 a year, 8% of 1.4. Right?
With no debt?
Yeah, and so can you do that? That's the question. And if you can do that in today's dollars, you can do that in tomorrow's dollars, because if you leave this alone, because it will have grown that much more.
That's right.
So in that clip, in case you missed it, Dave is saying that, ho-hum, we'll just put the money into growth stock mutual funds and we will get the average rate of return like clockwork, which is, 11 to 12%. And I think he said he would round it down to 11. And so you're going to get 11 and we'll just leave 3 in the account for inflation's sake. And then we'll pull out 8. And we'll live on the 8, and we'll grow, the nest egg will grow because we're not consuming the full rate of return. I don't know anyone that thinks 8% is a sustainable withdrawal rate, but one of the biggest issues that I think many people in our profession have with Dave Ramsey is the simple fact that he wants to ignore market volatility. He speaks about average returns as though they are a given. When you invest dollars into the stock market, no matter what type of equities you are purchasing, and Dave likes to use the S&P 500, it's one of his favorite things to reference. It's a well-known index. Many people understand exactly what he's speaking about. I'm going to pop up a chart here and walk you through a couple of things about the S&P. So the first thing I want you to take a look at is this is the performance, and it has been absolutely stellar for the S&P. And this is what Dave likes to reference. He likes to reference the returns. Well, notice there are multiple components to the return of a stock index. But one of the things I want you to see is, so if we look at the total return over a 10-year period, 14.82%, again, stellar. Price return, however, is 12.85. That is pulling out the dividends. So the first thing I want you to see is that when the first lady that was speaking, she's talking about living on the yield of your assets. Well, if you're doing what Dave has said and you're putting all your assets into this growth stock mutual fund or some type of fund that's going to, mimic the performance of the S&P 500, well, the S&P 500 has almost no yield whatsoever. The dividend yield has definitely compressed over time, and especially growth companies tend to pay little to no dividends at all. That money is reinvested into the growth engines of that business. So these two ideas do not coexist with each other. If you're going to be an income-based investor, then the types of investments you are going to be seeking, right? If you're going to be living on the yield of a portfolio, then you're going to be seeking investments that pay higher dividends or high interest, have high yields, and not necessarily are the highest price return or growth engine asset classes. On the opposite side of things, if you're doing what Dave is often telling people to do, which is invest in growth stock mutual funds, right? Well, growth stocks tend to not pay dividends. So you're mostly going to be relying on the price return over the long period of time of those assets. But that's not all. Let's go back to look at what Dave said. Okay, you're going to put the money in the S&P. The S&P averages 11 point whatever percent over, forever, and you're going to get this return. But this is the problem with averages. Averages are misleading. So take a look at this chart. This shows us the S&P 500 annual returns ranked over time, looking back to 1954 through 2008. Look at what we're seeing. Most years for the S&P 500 are not average at all. You have some really large outlier years, and you have some years that are below the average or negative. I think you only needed to make it through elementary school to understand that high numbers and low numbers, when combined together to create an average, the average tends to be somewhere in the middle. So when you completely divorce the risk equation from investing and you look at average rates of return, you are really gambling with your own financial future. And Dave should know this. And I don't understand why he continues to perpetuate this average rate of return as though it's the same as investing in a CD where, you're going to get this rate over, a 7-year period and you can set your timer by it. In fact, it's one of the biggest flaws that a lot of people make when they're creating their own retirement strategies using Excel spreadsheets. They will create linear growth rates with their portfolio as though those linear rates happen, and it completely eliminates sequence risk or order of return risk. So this is a major flaw in retirement planning, and I'm really shocked that it was actually exposed right here on Dave Ramsey's show. Now, if you're still with me from the beginning of the video, I showed you a clip where Dave Ramsey talked about people stealing hope, and now's the time to see that full clip in context. Stick with me to the end because Dave makes some pretty outlandish claims in this clip also, and I'm going to debunk those at the very end. So this clip happened about 2 years ago, and I remember when it happened. In fact, the young man that calls into the show actually contacted me on social media because he was thinking like, hey, I really want to talk to financial planners and investors who work in the industry and get their thoughts on this, because this went ultra viral. In fact, when I was doing research for this video, I could not even find the original clip from the Ramsey show because I think they may have taken it down. But this right here was one of the most ice cold takes I have ever heard when it comes to retirement planning. Let's check it out. So to set the table, he says he's called in, he's saving for his retirement. He saw an article on Dave Ramsey's website talking about withdrawal rates, and I want you to watch what happens next.
And I'm trying to best understand my plan with the end in mind. So how I'm going to turn that nest egg when I retire into income. I found on your website a little article that talks about 4 to 5% withdrawal rate. And I'm trying to run the numbers around that, and I thought I was close. And then about a month ago, George Camel released a video that said that the withdrawal rate for a 30-year type of RIG should be closer to 3%. So if I can establish financial independence comfortably, then I was wondering if I could use up on baby step 4 to pay off the house faster.
Okay, I'm a little confused because I don't know what the hell George is doing a 3% withdrawal rate, because that's absolutely wrong. I'm going to have to find out where that video is and get it taken down, because that's just wrong. You don't need to have a 3% withdrawal rate. That's ridiculous. Or I hope you misunderstood. I hope we didn't put out trash like that.
Was it 4 to 5%? Like that?
No, it shouldn't be 4 to 5%.
Okay, I can't. So first of all, Dave immediately reacts and says that the 3%, even 4 to 5% is trash, and that he wants to take it down. My favorite part about this clip when it happened is I watch Rachel, because I think Rachel's pretty sensible. And, in case you don't know, Dave is is her dad. And I genuinely think Rachel tries to save him in this video, because he starts to just go off the deep end. And I sincerely believe, like daughter to father, she tries to throw him a couple of lifelines to keep him from just saying some crazy stuff. But Dave is not having it.
It ought to be more than that. I mean, if you're making 12 in good mutual funds and the S&P is average 11.8, and if inflation for the
So again, Dave firmly believes what he's telling people. If you're making 12 in good mutual funds, you will always hear him say good mutual funds. Dave is not securities licensed, and he holds himself out through the regulatory bodies as a coach. So he can't get very specific with his language because compliance is very specific when you are securities licensed. So that's not a knock on him. That's just a reality of the situation. So you're always going to hear good stock mutual funds, good mutual funds, but he sticks to this 12% number like it is a scientific fact that if you are investing in growth stock mutual funds, you are going to earn 12%, and you could set your watch by it.
Last 80 years has averaged 4%. If you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So I'm perfectly comfortable drawing 8. But if you want to be a little bit conservative, 7, but sure not 5 or 3.
Well, I was trying to back check it because, with 3 to 5, I thought that was a big range. And a lot of the studies I found show...
Well, there's a lot of studies that are stupid in this space. It's just wrong. Listen, man, the math I just gave you is the math. If you're making 12% and inflation is 4, and you leave 4 in there, so your nest egg grows by 4, it's simple.
So here, Dave makes this comment again. If inflation is 4, and you leave 4 in there, you're growing the account by 4%. Well, that can't be true because if we're talking about inflation, meaning the cost of living goes up and your portfolio appreciates by 4%, that 4% is simply keeping you at parity for purchasing power. So you can't claim inflation being 4%. And so we're going to leave that quote 4% in there. And it, quote, grows by 4%. Yes, it might grow by 4%, but ultimately the purchasing power of those dollars is staying the same. That's the entire issue with inflation. So you can't claim inflation is 4%, so we're going to leave that 4% in there just to offset inflation. Well, that's not real growth. That's keeping your head that's you treading water. That's not growing the portfolio. That's just maintaining your purchasing power. So then if you actually are saying, okay, 4% inflation, 8% is growth, and you're consuming that, you're not growing the portfolio. You're not growing the purchasing power, at least of the portfolio. And those are very two different things.
8 is what's left over. So if you got $1 million and you leave 4% in there, that's $40,000. Okay, so you now have $1,040,000. So the next year you get a rate of return of 12%, 11.5% on the $1,040,000.
So Dave is talking about if you have $40,000 for the inflation number and you leave that in there, you have $1,040,000. Correct. You would if what Dave is saying is actually true. However, that $1,040,000 has the same purchasing power as the million did the year before because that's how inflation works.
And the next year, it'll be, $1,090,000, 1.1, right? And so your nest egg is growing by the rate of inflation, giving you a cost of living raise every year. So as long as you're doing that, you're fine. And so if you want to be a little bit conservative, maybe 5%.
Would you say
there's all these?
Here's where here's where I believe Rachel steps in and is trying to help him. She's trying to throw him a lifeline.
YouTubers out there have always put this 4% crap in the market, and I'm just irate right now that we have joined the stupidity.
Why is it that stupid, though?
It's too low. It's too low because it's not realistic. You do not need to live on 4% of your money for your nest egg to survive.
Yeah, even if you did a rate of return of 10% or something.
Yeah, and what it sets up is this guy now, he doesn't think he's got enough money, and he's already got $120,000.
By the way, the guy that he's talking about, I believe he said he was 30 years old. So we're not talking about a guy who is, 60 and maybe on the doorstep of retirement. This all started from a phone call from somebody who I believe was 30, had $120,000 saved up, and he's running the math on his savings and growth rates, and he wanted Dave's opinion on what was going on.
He's 30 years old. He's on a plan. He's on a plan to be very wealthy, and he's worried he's going to have enough money or not.
Yeah.
Because stupid people put out low withdrawal rates Like listen, if you think you can only pull off 4% off of investments making 12, where the flip is the other 8% going? Well, 4% of it went to inflation. That's where it went. The other 4% is just sitting there. So you are growing your investments instead of living off of them. I'm not destroying the nest egg. I'm not even touching the nest egg. I'm growing the nest egg by leaving 4% in there.
Yeah.
Taking 8 off of a 12.
So go a 10% rate of return. Go a little bit more conservative with your rate of return. Go 10%. What would you do with 10%?
Well, then 4 off of that. So 6.
6, yeah.
But why are you going to underinvest?
Yeah.
I mean, this year, the S&P to date
was 10%.
Is 10%, and we're not even at the end of the year yet.
Yeah.
You know, and everybody's talking about how bad the economy is. So, you know, most years mine have done much better than 12. And so
But if you can do your standard of living though lower than what you need, like if you don't need it, that's fine. Yeah.
Like I'm 62, or 63, I'm pulling nothing off of mine.
Right.
Because I don't need it. I still work. I still have an income.
Right.
Dave is a multi-millionaire, by the way.
This is when you go down these stupid nerd rabbit holes in these Reddit threads with these morons who live in their mother's basement with a calculator, and then you put that out in the dadgum community, and then people go, I don't have enough money. It's hopeless. I'll never be able to save enough to retire. $1 million should create for you an $80,000 income, boys and girls. So you should perpetually, like if forever, you should be able to pull 80,000 forever and never destroy it. Now and so when you tell people that $1 million creates a $40,000 income, you go, oh, I've got to have $2 million and I can't make that. Then this system doesn't work. So what you're doing with this bogus math is you're stealing people's hope. That's why I'm pissed about it, because it's hope stealing.
Okay. So hopefully you are not taking retirement withdrawal advice from Dave Ramsey, because anybody that can get that worked up over someone else's opinion about a withdrawal rate is not an objective third party. Okay. So one of the first things that you are, basically required to do, and I am a CFP, Dave refers to us as certified financial Pharisees. Gotta love the branding, right? But one of the standards that we're held to is the standard of objectivity. And so I hear stuff all the time that I think is absolute lunacy. However, when you immediately hear something and your first reaction is to fly off the handle and talk about people being absolute morons and living in their mother's basement and with their calculators, and look, the beautiful thing about the way that the internet has connected people is it really does open up the conversation for people to weigh in and weigh and measure ideas against each other, and to have iron sharpening iron. That is a principle of wisdom. Listen to this. Anybody that can get that wound up over someone else's opinion is not an objective third party. So Dave may want to hold to this idea that an 8% withdrawal rate is in fact the mathematical, undisputed heavyweight champion of how to do retirement withdrawals. He can have that opinion. He could also be absolutely wrong. In fact, one of the people whose research that spearheaded a lot of this, Bill Bengen. Bill, I'm sorry if you watch this video, if it finds its way to you somehow, if I mispronounce your name, my apologies, but he recently wrote a book. So I'll put a link about his book in the comments as well, if you want to go check it out. But he's the one who originated this withdrawal safe max rule that became known as the 4% rule. And first of all, it's not a rule. It was a finding through research. And that research continues to this day, where people are playing with it and they're pointing out different things that they would change or adjust, adding asset classes, thinking about taxes, costs of investments, all these different things. It's a living, breathing, working science, if you will, where people are experimenting and they're doing research and they're sharing their data with the community. And if you're involved in this field, you should want that. You should want people, the best and the brightest minds out there, testing things so that we can bring the best possible advice and solutions to the marketplace. But check out this graphic that he has in his own book, talking about withdrawal rates and the initial withdrawal rate and the success rates. So you can see here, he believes that right now the new Safe Max, the universal Safe Max withdrawal rate is right at 4.7%. But if you look on the tail end of the chart, when you get past 6.757%, it now becomes essentially a coin flip. And then if you stretch out there to, let's go to 8%, which is what Dave was saying, is 23.4%. Okay. So it's not to say that if you want to attempt an 8% withdrawal rate, that you may not be successful. It's just that the odds of success are really low. And then the other thing that wasn't even mentioned in the video was Dave threw out, if you have $1 million nest egg, you should be able to take $80,000 from that in perpetuity. Well, if we're going to not adjust that for inflation, then what do we do about inflation? Because if we're, leaving money in there to let the portfolio grow because of inflation, again, that math is just kooky. But what do you do about cost of living adjustments? What do you do about taxes if that $80,000 is taxable? And tax rates may or may not change over time. If you're married and you lose a spouse and your tax rates compress and you go from a married filing joint to a single file, but your standard of living still requires the same amount of money. There's lots of stuff that goes into planning for retirement. It's not just looking at a spreadsheet and straight lining your returns and saying, oh, if I get 12, then I can spend this.